Hello everyone, this is Dr. Tom Gerard, and this week we introduced the concept of cost volume profit analysis, and this is one of my favorite topics in management accounting. I've been teaching it for many years and I really like it. I'll tell you, anybody that's watched the television show Shark Tank, yeah, and I know that show's been on for quite a while. There's been lots of different episodes, but and it's gotten a real little bit of a TV flavor in the latter years. But if you look at the very early seasons, when the people were really more serious about um, making deals with people, but now it's sometimes it's more about TV, making good television than it is about real business analysis. But anyway, have you ever wondered how they can have somebody come in there? And I know it's edited, and they're probably really talk to these people for a lot longer than the 10 minutes or 15 minutes that the show devotes to it. But have you ever wondered how is it that they make these decisions on whether the company is a good thing to invest in from a financial standpoint? Not just that it's a good product or not, because you can have a really great product, and if the finances are not right, then you're going to lose money. But those sharks, it seems like they're always writing things down. They're asking those questions. And how is it that in 10 or 15 minutes they can make a decision? Well, quite frankly, many of the times, and you'll see this here in just a second, I'll show you, they're using cost volume profit analysis. And once you learn this concept, it's real easy. That's why it's so great, is because it's an easy concept to understand. And then once you know it, you're able to use it in all different types of situations. And so let me just share with you real quick. And again, this is not really from your book, but the concept is the same. This is a real basic model, so you can get the picture. But what they've done is they've taken the income statement, the traditional income statement that has sales minus cost of goods sold, and has gross margin, and they've switched it up because remember, now we're in management accounting. We're not in financial accounting where everything is regulated by generally accepted accounting principles. This is what we use as managers to operate and run a company, or in the case of the sharks on Shark Tank, to evaluate the viability of investing in a company. So think about this. So what they've done is they've switched it up. So we've got sales, our revenues, minus variable expenses, and you've already studied variable and fixed expenses. So fixed expenses come every month, and they're fixed by the month or the year in this case. But you get the picture. The variable changes as the volume of the product changes, or the volume of the service. Here we have 500 bicycles they've sold, $250,000. The variable expense based upon the 500 bicycles is $150,000, and that gives us what is called the contribution margin. The contribution margin, as you see down here in blue, is the amount remaining from sales revenue after the variable expenses have been deducted. So it's called contribution margin because this money contributes, first of all, to fixed expenses, and then it contributes to the net operating income. Okay, so you could see here, if I have $100,000 contribution margin, first of all, I have to take that to meet my fixed expenses, and that's 80,000 is what the fixed expenses, and that leaves 20,000 for net profit. Now, one of the great things about this, and I'm going to go here, is we can do it per unit. So you'll see, oops, sorry. You'll see what happens is, let me come back. This is a per unit contribution margin. It's the same materials. So they're saying 500 bicycles. They're saying that sells for $100 each, evidently. So we have $500 per bicycle minus the variable expense, which is, of course, your direct labor, your direct materials, and possibly overhead, depending on how they're allocating overhead. But they're saying variable expenses $300, and that leaves a contribution margin of $200. Now, one of the things that you look at is break-even point. So this is one of the questions that you'll see them or hear them, especially like I said in the earlier seasons of Shark Tank. They'll say, well, what is your break-even point? How many units do you have to make and sell to just break even? And the person should have this answer right away. We sell our bicycles and this is per unit. Sorry, I might have said $100, but it's $500 per bicycle. I sell my bicycle for $500. My variable cost per bicycle is $200, and I'm sorry, $300, and I have a contribution margin of $200 per unit. Hey, how much do you make on each unit you sell? $200. That's the question. Well, what's your break-even point? Well, my break-even point is I have to use my contribution margin to cover my fixed expense and not make any money. Just to break even, I have to manufacture and sell 400 bicycles. 400 bicycles is what I have to do just to break even. And as you'll know, that's one of those questions they ask a lot. This is the question you ask when somebody comes to you and says, hey, you went to business school. Can you loan me some money because I want to start a business? Well, you start asking the same questions the Shark Tank do. Well, how much are you making per unit or per service? If you're mowing lawns, how much money do you make every time you mow lawn, right? And have you taken into account on your variable and fixed costs those allocated costs we talked about in the last chapter, like your overhead costs? So here is a great model. Now, the interesting thing about this is, if I want to know how much money, if I sell, so here's the thing, what's your break-even point? 400 units. How much money do you make if you sell 401 bicycles? Right here, 401, $200. It's that contribution margin. So therefore, for every extra bicycle you sell, or you are making $200, the contribution margin. So this per unit contribution margin is very powerful, because now if I want to make $2,000, if that's $2,000 a week I want to make, then I have to sell 410 bicycles a week. If that's a month, I have to sell 410 bicycles a month to make $2,000 in profit, because it's telling you after your break-even point, for every bicycle you sell, you make $200. That's why that the Shark Tank people, they want to know, how are they going to get their money back? If you're breaking even at 400 bicycles and they say, well, how many are you selling? And you said, well, I'm selling 410. And they say, well, that means, in their mind, they're thinking, well, that means you're making $2,000 a week, but which you need to make because it's your business and you're doing a lot of work. But if I want to make money as an investor, then that means you're going to have to sell a lot more bicycles so that you can pay yourself and make a profit. But also, how much profit do I have? How much potential do I have? So there's a lot of great concepts in this contribution margin format. There's the graphing, where you can graph it. Here's your fixed expense. Your variable is in this area. So your sales, it'll tell you where your break-even point is on a graph, if you're a graph-like person. There's also the contribution margin ratio. This is where maybe I don't know the actual per unit cost. In other words, say I'm looking at a pizza parlor, and I know how much money the pizza parlor is making. I know their variable cost and their fixed costs, but I don't really know at this point, when I'm initial evaluation, what I'm making for every single pizza that I sell. Well, this is an idea where you go by sales volume, and the ratio is the total contribution margin divided by total sales, and that gives you a percentage. So that means each $1 increase in sales results in a total contribution margin increase of 40 cents. And of course, this is based upon our bicycle example. So this is basically converting it not per unit necessarily, but how much more money in sales. So how much more am I going to have to sell to make another dollar of revenue? So I know I'm getting long here on my introduction to this chapter, but I really love this topic. I could talk for hours on it. So let's take a look at this. This is something that I like to do. So this is a spreadsheet I use. So this, I call this my my what-if analysis. In fact, let me see if I can make this bigger for you. I got a what-if analysis here, and I use this. Say I'm evaluating something, and let me see. So here I am, and I have my little notepad on Shark Tank, and I say, well, you have an item, a widget, or whatever you want to call it, and we're selling them for $2.25, and I'm selling 15,000 of those, and my revenue is 33,750, and my variable cost is $1 per unit, $1 of the 125, and that's generating $15,000. Or I mean, sorry, that's costing me $15,000 for 15,000 units. My fixed cost is in this situation is 20,000. Now again, that could be my manufacturing overhead or whatever is in that fixed cost, but it's not going to change. And again, this could be per week or month or whatever. That's not what's important here. It's really the concept. But by selling 15,000 of them at $2.25, I'm losing money. So we've got to fix that, right? So I have some different options, and this is where my what if comes in. Let's see if I can move my thing down here. So the first what if is I could change my price. So let's say I want to go up to $2.50 in my selling price, and I got, okay, now you'll see it automatically changes. Now I'm making $2,500. Now that sounds pretty good, except for you did learn in your economics class that, you know, the price, as the price goes up, the demand goes down. So maybe I went up to $2.50, but now instead of selling 15,000, I'm only selling 14,000. Well, I'm still making profit at 14,000. So that's better to sell 14,000 at $2.50 than to sell 15,000 at $2.25. But you can see if I go up to 275 and now I'm only selling 13,000. Again, you play with these numbers. This is changing price. This is what if I change the price? The volume goes down, but my profit goes up. Okay, and then of course, you know, all the pricing things that you learn in marketing and your economics, you know, you have to take that in consideration. But this is just for cost volume cost volume profit analysis. So now here's the other thing. What if I sold more than 15,000? Let's say I could sell 18,000. Well, that's great. Now I'm making profit. Oh, except for what happens, how on earth am I selling that much more? Well, maybe I'm doing some advertising. Maybe my fixed cost goes from 20,000 to 25,000. Oh, and that's not good. So if I have to spend an extra $5,000 in advertising or some fixed cost item to make my unit sales go up, then in this case, if I only go up to 18,000 for $5,000 more fixed cost, then that's not going to work, right? But maybe I'm not going to do that kind of advertising. Maybe I'm going to pay my a commission to salespeople, and it's going to cost me $1.25 variable cost. It's because I'm paying 25 cents. Now remember, we're selling thousands of widgets, so it's not like, you know, somebody's only going to make a quarter for selling it. But you'll see here, oh, well, now I'm down to I'm losing money again. So here is, what do? I'm going to sell more units to create a profit, but to sell other units, how do I do it? I have to increase variable costs or fixed costs possibly. Okay, so now the next scenario is this one. I change my, and I got it in blue, see? So now, instead of buying my products maybe made in the USA or wherever you think is a great place to have manufacturing, I've switched to buying things from China, and I say China, it could be anywhere, right? But so basically, let's say instead of it costing me per unit $1, my raw materials I'm buying now, and I'm only spending uh, 75 cents. And you'll see, okay, wait a minute, now that's great because I cut my manufacturing costs. And as you know, that's a lot of times what the sharks do because they have connections in manufacturers. However, what happens when you get cheaper components? Well, maybe your volume goes down. Say it goes down to, well, let's just do 14,000. Why? Because now you have more defective units that you've manufactured that you can't sell because they're defective, either defective in shipping or the material is not as good. You have customers that are dissatisfied and return them because maybe your raw materials are not, or your manufacturing in general is just not quite as good as it is with a better raw material. Now you'll see here we've dropped it to 75 cents, and if we could drop it to 75 cents and still sell 14,000, then that's not good. That's better than losing money, right? So that's a good thing. But what if it dropped to 13,000 because of the defective, So this is playing with cost per unit. So what's my next one? Fixed cost. I'm going to reduce my fixed costs, and so my fixed costs could be, well, I'm going to stop doing some advertising that I've been doing, and I'm going to reduce my fixed cost to 18,000, say. And there, oh, we're still, oh yeah, we're making some profit. It's not a lot. If I could drop it more, let's go to 17,500, right? So I drop my fixed cost, and now at least I'm making some profit instead of losing money. But there again, every time I change something, how did I change fixed costs? Did I stop doing advertising? If I stop doing advertising, then guess what? Maybe my uh, units sold. I'm not selling as much. So basically, you can play with this. I call this my what if analysis, but you got multiple things you can do when you're evaluating a particular product. Change the price and see what that does. I can try to get the units sold to go up. That might cost me more. I might change the cost, my variable cost per unit, or I could try to manipulate my fixed cost. Now, the thing is, this story and this whole scenario is about cost volume profit analysis. And you'll see that by having what I sell a unit for and what it costs me to make it and my fixed costs, how great this concept is for evaluating different products, different services. I mean, this could be, one of the ones that I talk about in my live classes is the lawn mowing guy, right? I'm going to mow a lawn for $50, and I'm going to mow 10 lawns a day, and then it's going to cost me, say $10 in variable cost per unit, because I got to have some gasoline and I've got to have some insurance out of there or whatever. But maybe my insurance is a fixed cost. And for this time, I might have, you can see here now if I have $500 in revenue, and that's a day. Let's just say it's costing me, a day. Let's just say this is a day. Let's say it's $300 a day. That's that. So I'm making a profit, even if it's costing me $300 a day in overhead costs, which means that's my insurance, my licensing, my storage for my lawnmowers and stuff. Maybe my debt service where I borrowed money to buy the equipment, fixed costs. And my variable cost per lawn mowed is only $10. But you'll see now, if I mow $10 a day, mow 10 lawns a day, at $50 each, I can make $100 a day in this scenario. So the question you have here, and this is another thing, I know this is getting to be 20 minutes talking, but so think about the Shark Tank again. If I'm in this situation, then I'm evaluating capacity. What is my capacity? Well, if I did 50 lawns, if I did 10 lawns a day, that's 5 days a week. That's 50 a week. Wow, that's getting pretty good. But now my $300, was that a day? A day, 3 times 5 is 1,500. You know, so now I'm looking at $300 a day times 5 days, and now my profit's $500 a week working. Now here's the thing where I'm going with this. So for some people, a lawnmower person, this is not bad. I'm making $500 a week net after everything's paid for, take home money. You know, we could even say that our taxes are paid and all that stuff. So now here's the problem. You'll see that what is my capacity? My capacity is if I work 5 days a week, every week, then my maximum money that I could make with this scenario is $500. So how am I going to make more money? How am I going to mow more lawns? If I mow, you know, 6 or 7 lawns a day, you know, then that increases it, right? But at some point, I reach a capacity. Oh, I could work Saturdays. I could work a 6 days a week, you know, and at some point, even, you know, I run out of time. I can only mow so many lawns a day. I can only mow so many lawns a week. If I'm working 6 days a week, I could mow a lot more and make some money. But the point where I'm going with that is I have a limit to how much money I can make, right? And so there again, the Shark Tank says, wait a minute, what's the maximum capacity that you can do? How many units can you make? If it's a service, how many service can you sell? What? Well, I could do more if I hired people. Oh, well, wait a minute. Then there goes your fixed costs through the roof because now you've got all kinds of insurance that you have, and you have to pay FICA tax and all those things. So anyway, cost volume profit analysis, like I said, one of my favorite topics in management accounting because it really reduces something that is valuable to something relatively simple to do. Hey, thanks for listening, and I hope that you guys have a great week, and God bless you all, and this is going to be a great chapter in management accounting.